The more intelligent you are, the better you may become at explaining why you are right. That sounds like an advantage. In investing, it can become a trap because a spreadsheet can make an assumption look precise. A complicated strategy can make an idea look sophisticated. A successful trade can make luck to look like a skill that you have. And confidence can quietly become certainty. The strange part is that none of this requires ignorance. It can happen to people who understand economics, finance, mathematics, and business better than most. So perhaps the real question isn't why do smart people make stupid financial decisions? It is what happens when intelligence becomes too good at defending a belief. Start with a simple distinction. There is a difference between being able to understand a financial decision and being able to make a good financial decision. And research actually gives intelligence some credit here. A 2022 study by Shannon Lin and Timothy C. Bates, published in the journal Intelligence, examined whether cognitive ability was related to economic knowledge and financial literacy. Across two pre-registered studies involving 1,356 participants, they found that people with higher cognitive ability tended to have greater economic knowledge and better financial literacy. The findings were replicated in the second study, and the relationship between cognitive ability and economic knowledge remained even after accounting for education and economics training. So intelligence really does help. Financial knowledge matters. Learning matters. But investing asks a second question, which is not, can you understand this? But it is, can you make a good decision with what you understand? Those are not the same abilities. Knowing how valuation works doesn't tell you whether your valuation is correct. Understanding leverage doesn't tell you whether you can survive it. Knowing probability doesn't automatically make you good at estimating probabilities. And financial literacy doesn't guarantee that you know how financially literate you actually are. That last distinction is where things get interesting. A 2024 study examined 72,847 clients of a large Belgian online broker. The researchers compared what investors believed they knew about finance with what they actually knew. The more overconfident investors traded more frequently. They also incurred higher transaction costs, and the effects became stronger as overconfidence increased. But there is an important point. The study did not establish that these investors necessarily performed worse than rational investors. So the lesson isn't overconfidence always loses money. The stronger lesson is overconfidence changes behavior. It can make someone more active, more willing to take risk, and more certain than their actual knowledge justifies. A 2024 study involving 36,268 Chinese respondents found that overconfidence in financial literacy was associated with greater investment in risky assets. And the pattern isn't limited to China. A 2025 study of Japanese investors found that people who were overconfident about their financial knowledge were more likely to engage in panic selling during market downturns, even after accounting for their level of financial literacy. Now we have the first clue. The problem may not begin with, I don't know. It may begin with, I know enough, and then quietly, I know enough to stop worrying. That gap is the subject of this entire story. History gives us an important clue. Irving Fisher was one of America's most prominent economists. He wasn't an uninformed speculator, yet his optimistic views around the 1929 market crash became historically famous, and his personal financial position was badly damaged. The lesson is in that economists can't forecast markets. It's that expertise doesn't eliminate uncertainty. You can understand markets extremely well and still be wrong about what happens next. Now move forward several decades, the internet boom. Cisco was a genuine technology leader. Its business was deeply connected to the expansion of internet infrastructure. The technology thesis was real. The market opportunity was real. The company mattered, and yet its share price rose approximately 3,800% in the 5 years before the March 2000 Nasdaq peak, reaching above $80 before eventually collapsing nearly 90% by late 2002. So what went wrong? This is where the distinction between business quality and investment quality becomes essential. You can correctly conclude the technology is important, demand will grow, the company has competitive advantages, management is capable, the industry has a long runway, and still make a terrible investment because there is another question: what are you paying for all of that? A great business can become a poor investment when expectations become too high. Growth can be real, margins can be real, competitive advantages can be real. But if the price already assumes extraordinary future success, even a good outcome can disappoint investors. This is one of the easiest mistakes for an intelligent analyst to make. The analysis becomes so focused on whether the company is excellent that the price becomes secondary, and then another mechanism appears. I know it's expensive, but someone else will pay more. Now the investment thesis has changed. You are no longer primarily asking, what is this business worth? You are asking, what will the next buyer believe that can work? But it is a bet on future psychology, and once that happens, confidence becomes increasingly important, because the more convinced you are that you understand the future, the easier it becomes to tolerate a price that already assumes you are right. The first mental model is therefore simple. Understanding a business is not the same as valuing an investment. But that still doesn't explain why confidence can become so powerful. For that, we need to look at success. Failure is uncomfortable, but failure has one useful property. It forces questions. What did I miss? Which assumption failed? Was the process wrong? Was the timing wrong? Was the thesis wrong? Success doesn't always force these questions. Suppose an investor takes 5 aggressive decisions. All 5 work. What caused the success? Skill, a favorable market, liquidity, sector momentum, valuation expansion, or luck? Possibly all of them. But the investor doesn't experience 5 separate explanations. They experience one result: I was right. And that can be dangerous, because markets contain randomness. A good outcome does not tell you how much of the outcome came from skill. Success can therefore reinforce a process that has never actually been tested. The sequence can become ability, success, confidence, more risk, more success, more confidence, until confidence begins moving faster than evidence. This is where intelligence can become particularly useful and particularly dangerous. An intelligent person can construct a sophisticated explanation for almost anything they already want to believe. That leads to one of the most useful ideas in this video. Intelligence can turn an investor into a very good lawyer for a bad investment. A lawyer's job is to build the strongest possible case. An investor's job is different. An investor must try to destroy the case before committing capital. Healthy analysis looks like hypothesis, then evidence, and then contradictory evidence, and then revision, and then finally a decision. The dangerous version looks like hypothesis, then a model, and then a supporting evidence, and then rationalization, and then a larger position. Notice the difference. Both can contain research, both can contain spreadsheets, both can contain sophisticated language, but only one is designed to discover whether the original belief is wrong. And this gives us a better definition of confidence. Confidence is not the problem. Calibration is the problem. Think about a weather forecast. If a forecaster says there is a 90% chance of rain, we can eventually test that confidence. If it rains roughly 9 times out of 10 situations where they make that prediction, the forecast is well calibrated. If it rains only 6 times, the confidence was too high. Now bring that idea into investing. Someone who says, I am 90% certain, may sound more knowledgeable than someone who says, I am 65% certain. But if the second person's confidence matches the reality much more closely, the second person may be making better decisions. That is calibration. It is not how confident am I, but it is how accurate is my confidence. And this is the first major shift in this video. The objective is not to make the intelligent investors less confident. It is to make their confidence better calibrated. But there is another way intelligence can become a trap: complexity. Intelligent people can understand complicated things. That is an advantage. But there is a subtle psychological danger. Once you can understand something complicated, you may start believing that complexity itself is valuable. A simple investment can feel boring. A complicated investment feels like a puzzle. Derivatives, structured products, alternative funds, private businesses, complex financial models. The problem is not that these things are automatically bad. Some complexity creates genuine opportunities. The problem is confusing. I can understand this with the thought this is worth owning. Every additional layer of complexity creates another way to be wrong. Your assumptions can be wrong. Your estimates can be wrong. You can underestimate how difficult it will be to sell an investment when the market turns against you. You can misunderstand the incentives of the people managing your money. You can miss problems hidden inside the accounting. And you can overlook leverage that makes a small mistake much more dangerous. There is an important paradox here. A spreadsheet can calculate a valuation to 2 decimal places, while one of the most important assumptions behind that valuation may be something you cannot measure with anything close to that precision. How management will behave, how competitors will respond, how the industry will change, what the future will look like. So sophistication should not mean how complicated is my analysis. It should mean how many unnecessary ways have I created to be wrong. The idea also changes how we think about successful investment funds. A fund delivers exceptional returns. Its performance creates a reputation. That reputation attracts more investors and more money. But past performance does not guarantee that the same performance will continue. The Berg-Green framework offers one explanation. As successful managers attract more capital, managing a larger pool of money can make it harder to maintain the same advantages. The real-world evidence is more nuanced, and some performance persistence can exist. So the right conclusion isn't past performance means nothing. It is past performance is evidence, not a guarantee. And there is another problem. Even when a fund performs well, investors can still earn disappointing returns if they buy after strong performance and sell after a decline. Good fund, bad timing, which led to poor investor outcome. The fund didn't necessarily fail. The investor's behavior may have. Then there is an even more uncomfortable example. Bernard Madoff. Madoff had almost everything that could make an investment appear trustworthy. Prestigious clients, a sophisticated strategy, consistent returns, a powerful reputation. But underneath the impressive story was a very simple question. Were the trades actually happening? Some private firms conducted their own due diligence and found enough red flags to decide not to invest. They questioned the strategy, they questioned the numbers, and they questioned whether the trading activity Madoff described was actually possible. The important point is what happened next. The problem wasn't that anybody questioned Madoff. Some people did. The problem was that investigators did not independently verify the underlying trading activity. The SEC's Office of Inspector General later found out that investigators encountered contradictions and suspicious information, but often relied on explanations provided by Madoff rather than independently verifying the underlying trades. In one examination, investigators even drafted a request for independent trade data but never sent it. That creates a powerful lesson. A convincing explanation is not the same as independent evidence. A prestigious reputation is not evidence. Consistent returns are not evidence that underlying trades are real. And intelligence is not a substitute for verification. The question is much simpler. Can I independently verify that economic activity I am being told about actually happened? That is where sophistication has to give way to skepticism. And now we have another piece of the puzzle. Sometimes the problem is in that you misunderstand the investment. Sometimes you understand it, believe in it, and still cannot survive what happens next. This is where leverage changes the entire equation. Suppose an investor has $10,000. They borrow another $10,000. They now control $20,000. A 20% decline produces a $4,000 loss. That's 40% of the investor's original equity before financing costs. Notice what happened. The investment fell 20%, but the investor's equity fell 40%. The investor doesn't need to be permanently wrong. They simply need to become unable to survive the temporary decline. That is what leverage does. It changes the relationship between market movement and personal survival. And this is why intelligence cannot neutralize leverage. It makes mistakes more consequential. Household finance research provides a much larger historical example. During the US housing boom, Mian and Sufi found that home equity borrowing was a major contributor to the sharp increase in household leverage from 2002 to 2006. Their research estimated that $1.25 trillion of the rise in household debt from 2002 to 2006 was attributable to existing homeowners borrowing against increased home values. They also estimated that this borrowing accounted for at least 39% of the new defaults from 2006 to 2008. The point isn't that borrowing is always irrational. It is that leverage changes the consequences of uncertainty. And this leads to a distinction that investors often overlook. Being right and being able to survive being right are different skills. Michael Burry is a useful example here. Not because investors should imitate his enormous bet against the housing market. They shouldn't. His value as an example is that his thesis eventually proved correct, but the market did not immediately validate it. There was a long period in which being right looked very much like being wrong. That requires something beyond intelligence, patience, risk control, and the ability to tolerate uncertainty without constantly changing the thesis simply because the market disagrees. So now, the puzzle has changed. We started with intelligence, then we discovered knowledge. Knowledge became confidence. Confidence could become overconfidence. Overconfidence could change behavior. Valuation could turn a correct business thesis into a poor investment. Complexity could create false sophistication. Reputation could replace verification. And leverage could turn a temporary mistake into permanent financial damage. There is now only one question left. What should intelligence actually be used for? The answer is not to become less intelligent. It is to use intelligence differently. Don't use it merely to build the strongest argument. Use it to attack your own argument. Before an important investment decision, you need to ask, what exactly am I buying? If you cannot explain the economic mechanism clearly, you may not understand it as well as you think. How does it create value? Explain without jargon. What am I paying? What growth is already assumed? What margins? What valuation? And what would prove me wrong? Not what would make you uncomfortable. What would actually invalidate the thesis? What are the alternatives? An investment should never be evaluated in isolation. What happens under stress? Whether it's lower growth, lower margins, more competition, lower valuation, or less liquidity. And how much I can lose? Not theoretically, personally. What level of loss would permanently damage your financial position? Then ask something less mathematical. Is ego involved? Would you make the same decision if nobody ever knew you owned it? If the answer changes, the portfolio may be becoming a status competition. Has the thesis changed? Not the price, not the market mood, the economics. And finally, what information would change my mind? That question may be the most important one in this entire framework, because if the answer is nothing, you are no longer testing a hypothesis, you are defending an identity. Return to the question from the beginning. Why do smart people still make terrible investment decisions? The answer is not that intelligence doesn't matter. It does. Intelligence can improve financial knowledge. Financial knowledge can help people participate in financial markets and make better financial decisions. Experience can improve pattern recognition, but none of this guarantees calibration. And that distinction changes everything. Cisco shows us that a great business can still be a poor investment when expectations become excessive. Bernard Madoff shows us that a sophisticated story is not a substitute for independent verification. Leverage shows us that being right eventually may not matter if you cannot survive the path. Michael Burry shows us that conviction requires patience when reality has not yet caught up. The research shows us something even more subtle. Confidence itself is not the enemy. Confidence that outruns knowledge is, and perhaps that is the real hierarchy. Intelligence helps you understand. Financial literacy helps you understand financial concepts. Experience helps you to recognize patterns. But humility helps you recognize uncertainty. Discipline helps you avoid unnecessary action. Risk management helps you survive mistakes. Patience allows time to work. Calibration tells you how much confidence your evidence actually deserves. And intellectual honesty determines whether intelligence is being used to discover the truth or defend a belief. So the smartest investor is not necessarily the person with the most complicated model or the strongest conviction or the most impressive explanation. It may be the person who can say, "This is what I believe," and in the same breath, "Here is what would make me change my mind." Because the goal of intelligence is not to make you impossible to prove wrong. It is to make you better at recognizing when you are wrong. And that brings us back to the sentence that started this story. I understand it. That can be the beginning of a good analysis, but it should never be the end. Because the moment understanding becomes certainty, intelligence stops being a tool for discovering reality. It becomes a tool for defending a story. And sometimes, the most dangerous thing about being smart is being smart enough to explain away the evidence. This video is for educational purposes only and is not financial or investment advice. Investing involves risk, including possible loss of capital. Please do your own research, consider your individual circumstances, and consult a qualified professional where appropriate.